Welcome to Finder Investors. My name's Kylie. Okay, so the stock market has seen pretty stunning growth since the COVID-19 stock market crash in 2020. I mean, the US market alone has seen an 80% gain since it hit its lowest point, and it's continued to smash record after record since. But history suggests that the stock market will crash at some point in the future. After all, no bull run has ever lasted forever. So in this video, I'm going to take you through 5 reasons why the stock market might crash in 2021, 2022. Okay, reason number 1. History tends to repeat itself. So the Great Depression of 1929 is actually showing some alarming similarities to what we're seeing today. In 1929, over the course of a few days, the Dow Jones dropped 24.8% and the US GDP went down by 30%. And in 1929, new listings on the New York Stock Exchange hit new record highs. Meanwhile, in the first quarter of 2021, IPO listings jumped 85% and proceeds jumped over 270% year on year. Another similarity is the sudden jump in retail investors into the stock market. In the late 1920s, Wall Street grew to record numbers as investors wanted to cash in on the growth. That's very similar to what we're seeing today. In 2021, trading apps like Robinhood, eTrade, and eToro have seen booming record numbers, with multiple platforms reporting over 3 million new subscribers in 2020 alone. And in Australia alone, during the period of February to May in 2020, we saw over 4,000 new investors a day signing up to share trading platforms. Like, that was insane. And lastly, the US Fed's easy money policies are looking pretty similar to what we saw in 1929. Low interest rate policies back then went on for far longer than many economists hoped they would. For example, the Fed's interest rate was down to 0.5 in 1927. Compare that to 2021, where the Fed has pledged to keep ultra low interest rates until we start to hit inflation targets and improve employment rates and the economy starts to grow. And in the meantime, the Fed's total assets have increased from 4.1 trillion to 8 trillion since the start of 2020 alone. Okay, before I go on, don't forget to hit the like and subscribe button. And don't forget, this is not financial advice, it is just a general overview. Okay, so the second thing to remember is timing. Double-digit stock market declines happen every 1.87 years on average. And okay, stock markets don't adhere to strict timelines, but doing the maths, I mean, it makes sense that we might see a stock market crash over the next few years, if not even over the next 12 months. So just for context, since the beginning of 1950, the S&P 500 has had 38 instances of stock market declines of more than 10%. So that's a double-digit decline on average every 1.87 years. That's a lot of crashes. The good news is that stock markets tend to correct pretty quickly after a stock market crash. Of course, it totally depends on the crash itself. In 2020, we saw the fastest recovery on record. The GFC, however, took a lot longer. In fact, it took about 11 years for the Australian stock market to recover and about half that time for the US stock market to recover. That being said, the stock market still continues to be one of the best investment tools that we have on hand. Okay, reason number 3 is stock market valuations are through the roof. So we hear a lot about the stock market being overvalued. Probably the best way to look at this is by looking at PE ratios. So PE ratios look at stock prices relative to the earnings that the company is making, so relative to their profits. So as of April 2021, the S&P 500 PE ratio hit around 37. That's well over double its historic annual average of 16.8. What this kind of boils down to is that investors are twice as optimistic about the stock market as they normally are. They're willing to pay higher stock prices even though the companies aren't necessarily earning more. So there have only been 5 instances over 150 years where the S&P 500 PE ratio has surpassed and sustained above the 30 level during a sustained bull market. And the 4 other instances before now saw the stock market retract by 20% or more. So if history is going to repeat itself, we'd be looking at a pretty significant crash. Okay, so number 4 is inflation. So we touched a bit on inflation when we talked about history repeating itself before, but it's a big piece of the puzzle in and of itself. So let me just give you a brief explainer on how inflation works. So I mentioned before that retail investors have joined the stock market in record numbers, but they still only make up about 20% of the stock market. The other 80% are made up of institutional or private investors. These are like major investment banks and other big businesses. Okay, so these institutional investors aren't dummies. They're confidently buying up stocks on the assurance from the Federal Reserve that it will continue to print money and continue to boost the economy, just like it did in 2020. The Fed invested $3 trillion in 2020 alone, and they've said they're prepared to continue doing so for some years to come. This is why the stock market can continue to perform well even during a depressed economy. But something has to give eventually. If the Fed prints endless amounts of money, that will devalue the US dollar and inflation will go through the roof. So in order to close the gap between the depressed economy and the booming stock market, one of two things needs to happen: an economic recovery or a stock market crash. Looking at what's going on with the pandemic globally, it's hard to imagine the latter to be true. But then again, we are rolling out the vaccine. Who's to say? Which brings me to my next point. COVID-19. Despite COVID, global stocks started 2021 on a high. It kind of looked like the stock market was in a steady recovery. But some analysts warn of an epic bubble. We're also seeing that the COVID recovery isn't actually adhering to any kind of projected timeline that our leaders are telling us. The ever-extending estimates of when we return to a new normal go to show that there's no linear trajectory out of this pandemic. With huge surges of infections like the one we're seeing in India and an uneven distribution of vaccination, the market is at risk of a rising panic, which makes it impossible to know when a stock market crash might be coming. Thanks for watching. Don't forget to hit like and subscribe, and stay tuned for more investing content.